This is Brad Barry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this Market and Economic Update. In this video, we'll discuss bond market volatility that is pushing interest rates and yields higher. Among other factors, this is a result of tariffs as well as a dispute between the White House and the Federal Reserve. It's important to remember that short-term market volatility is normal and can be caused by a variety of factors. This volatility can create both challenges and opportunities for income-focused investors. It also emphasizes why bonds should not be the only diversifier in a truly diversified portfolio. Over the next few minutes, we'll explore what's causing volatility and how investors can look for opportunities in the current environment. First, what's causing bond market volatility? As this chart measuring the implied volatility of U.S. Treasury shows, bond market volatility is well above its historical average. In fact, it's been elevated for the past 3 years. Many people believe that stocks and bonds always move in opposite directions. That is simply not true, as we've seen in recent and past history. This is why having a portfolio of just stocks and bonds can lead someone with the false impression of protection and diversification. Again, we're seeing another situation where stocks and bonds are not behaving as many would expect. Current policy uncertainties around tariffs and the Fed are creating exceptions to this normal pattern of bonds being low volatility and a diversifier to stocks, thus increasing bond market volatility. This is because increased uncertainty is making it harder for investors, households, and businesses to plan effectively. This means that it's harder to forecast where the economy may be in a few months, let alone in a year. This has driven interest rates higher and has acted as a headwind to bond returns. Now, you're probably tired of me saying it's the bus that you don't see that hits you. But that is exactly the case here. You see, when you only have stocks as your driver of returns and bonds as your sole diversifier, you are not diversified. Think of it this way. When you have a mission-critical objective, you wouldn't just have 1 or 2 systems in place to make sure it worked. You'd have numerous redundant systems in place. This is exactly what the multidimensional asset allocation philosophy is built upon. Next, despite higher than expected interest rates and increasing bond volatility, this chart shows that most bond sectors are still holding up year to date, including U.S. aggregate bonds, treasuries, and investment-grade corporate bonds. Thus, bonds should be part of a truly diversified portfolio at all times. They just should not be the only diversifier in a portfolio. Just like equities should not be the only driver of returns in a portfolio. Now, corporate bond investors are paying particular attention to quality levels. Investment-grade spreads remain tight while high-yield spreads have widened but are still narrower than during past crises such as the 2008 financial crisis and 2020 pandemic. Municipal bonds have experienced greater volatility recently, with elevated muni ratios making them more attractive compared to treasuries, particularly for high tax bracket investors. As you can see, there are many variables that go into bond investing, and having professional active management within the bond sector can help to provide additional diversification. As part of our philosophy on multidimensional asset allocation is diversifying not just asset classes, but also utilizing different investment disciplines and approaches. Thus, having an index-based bond strategy combined with a tactical or active bond strategy can help to add diversification. Finally, bond yields currently offer attractive income potential compared to recent historical averages. For example, investment-grade corporate bonds are currently yielding above 5% compared to an average of just 3.8% since 2009. This chart shows some traditional sources of bond yield with the blue bars showing the latest yield to worst and the gold diamonds illustrating the yield to worst average since 2009. This shows that even though bonds may be volatile, they can still play an important role in generating income in a portfolio. Anticipated Fed cuts later this year could provide a further tailwind for bond prices while allowing investors to lock in current higher yields. The current environment presents an opportune time for income-focused investors to evaluate fixed income allocations along with different alternatives in their portfolios to ensure a truly diversified approach, and thus helping to provide an overall smoother return experience. I hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click on the link below or visit our website at dynamicwg.com. Email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.